So let's continue talking about issuing stock. So we're going to go through the journal entries now. Now, remember, we typically, when we issue stock, we can go through what's called an underwriter, which is one of a large investment bank, Goldman Sachs, JP Morgan, something like that. And essentially, they're issuing the stock for us. You don't have to go through an underwriter, it's just common to go through the underwriter. So the first time that we sell the stock, selling what I would call the new stock on the market, that happens in what's called the primary market. That's when we, the corporation, receive the money from that. We receive the what's called the issue price. That's that initial selling price. We're going to get that money. Now, once we get that money, whoever bought the stock, so let's say we're Smart Touch Learning and I put my shares of stock out there and Johnny buys 5 shares of stock. Johnny gives me the money, me Smart Touch Learning. Now Johnny can turn around and hold this stock or he can sell it. And when he sells it, let's say Johnny sells his stock to Jane, Jade is giving Johnny the money. I, the corporation, don't receive any money from that transaction. So as a corporation, I only get money when stock is issued, that new stock is issued that first time. I don't get any money when that used stock is bought and sold, okay? So this is something I really want you to understand, because as stock prices rise and fall, the corporation isn't actually gaining or losing any money unless they had sold stock that day, which, they probably didn't have an issuance that day. It's not very common that companies have issuances of stock. So as we see stock prices fluctuate, I need you to understand the corporation isn't getting any money from a higher stock price. They're not losing any money when the stock price falls. One of my personal pet peeves is to hear people say, "Oh, did you see Amazon lost so much money today?" No, Amazon did not lose a dime. Their stock price may have fallen. They did not lose any money. They didn't lose a dime. It had no effect on them. Apple's stock price may have tripled. Apple didn't make any money off of that. The corporation only makes money when the stock is sold in the primary market, that initial sale. After that, it has no effect on the company's financial statements. Now, corporations are very concerned with their stock price because it represents investors' perception. So a high stock price means investors think highly of you. A low stock price means they don't think highly of you. It's a measure of your reputation, if you will. But it didn't cost them any money, and it's not bringing them in any money either. So it's very important to me that you understand that, because we hear people say these incorrect things all the time. So let's say that we have common stock. It has a $1 par value. We are authorized to issue 20 million shares. We're going to issue 15,000 shares at par value, meaning the selling price of the stock is the par value of $1. So we're selling 15,000 shares for $1 each. So we're going to receive cash of $15,000 and we're going to credit that common stock account for $15,000. Remember, common stock is part of the O in Aid Reveille. Common stock has a normal credit balance. Now, most of the time, we don't sell the stock exactly at par value. Again, par values are typically extremely low. Disney's par value is 1 cent. For our purposes, par values are usually $1 because we don't like dealing with cents when we're working problems. So most of the time, we're going to issue the stock above par value. So here we're told we issued 3,000 shares at $5 per share. So in total, we're going to receive $15,000, right? But remember, the par value is $1. So we're going to debit cash for $15,000, but we're going to only credit common stock for $3,000 for the par value. That $4 difference is a premium, and that gets credited in an account called paid in capital in excess of par. So here we see our entry where cash is debited for the selling price, Common stock is credited for the par value, and then paid in capital in excess of par is credited for the premium, the amount over and above par, the $4 over par value. So on our balance sheet, if we look at the stockholders' equity section, notice we're going to list common stock at par value. So at this point, we've issued 15,000 shares plus 3,000 shares. So we've issued a total of 18,000 shares with a $1 par value. So therefore the 18,000. Then we're going to list the paid in capital in excess of par value. So those together give us that total paid in capital. And then we add in retained earnings, and that gives us total stockholders' equity. So if you remember when we initially learned our accounting equation, we said assets equal liabilities plus stockholders' equity, where stockholders' equity was made up of paid in capital and retained earnings. This is that paid in capital portion right here. Now, I want to point out that on the face of the statement, we're given a lot of detail about the common stock, and nowhere else on financial statements are we given that. So they don't just tell us common stock. They tell us it's common stock with $1 par, 20 million shares authorized, 18,000 shares issued and outstanding. So they give us a lot of that detail there on the face of the statement. Now here we're issuing some no par stock. So if it's a no par stock, then we just credit the common stock for account for whatever the sales price is. So here we issued 3,000 shares for $5 each. We'll just debit cash, credit common stock for 15,000 because that's the no par stock portion. And so if we were to look at the stockholders equity section of a no par stock, again, this is, I deleted some of the transactions, so some of the numbers may not exactly make sense, but here we've got no par stock, 20 million shares authorized, 18,000 shares issued and outstanding. In other words, there's no paid in capital in excess of par account. Now, when we issue preferred stock, we're going to do it almost exactly the same way as we do when we issue common stock. We're going to credit the preferred stock for the par value and then credit a paid in capital in excess of par for the premium or the amount over and above par. Now, preferred stock will almost always have a par value because, remember, preferred shareholders get a guaranteed amount of dividends, a set amount of dividends, and that set amount of dividends is calculated most of the time based on par value. So here we're told we issued 1,000 shares of our $50 par. So again, preferred stock is going to have a much higher par value. 6% preferred stock for $55 a share. The 6% is referring to the dividend rate. So when and if we pay dividends, the preferred shareholders will get dividends equal to 6% of par value. So 6% of $50, which is $3 a share. Now, you may be thinking, wow, $3 a share is not a lot of dividends. In reality, that is a whole lot of dividends. I will tell you, my Disney dividends are about 80 cents a share. So $3 a share is a lot of money for dividends. So we issued 1,000 shares at $55 a share, so we'll be debiting cash for $55,000. We'll credit the preferred stock account for the par value of $50,000, and then we'll credit the paid in capital in excess of par for the premium of $5,000. Now, when we look at the stockholders' equity section, notice that preferred stock is going to be listed first. So we have preferred stock, then the paid in capital in excess of par for preferred, then the common stock, then the paid in capital in excess of par for common. All of that added together is the total paid in capital. Then you throw in the retained earnings, and that gives us total stockholders' equity.